Today we're diving right into the world of home equity options, comparing a home equity loan to a HELOC.
Yeah, right. It's really interesting how both options use the equity in your home as collateral.
Exactly. Now, a home equity loan gives you a lump sum up front with a fixed interest rate, which means your monthly payments are predictable, making budgeting more
hmm
straightforward.
And that's super helpful when you have big one-time expenses like, say, a major home renovation, right?
Yep, absolutely. It's like having a set amount you can count on. But on the flip side, a HELOC is more like a revolving line of credit, similar to a credit
Yeah,
card, where you borrow as needed over time.
right. But with that flexibility comes the risk of variable interest rates, which can make your monthly payments uh, a bit unpredictable over the long haul.
Exactly, exactly. Plus, with a HELOC, you only pay interest on the amount you draw, not on the whole credit limit. It's like having money on standby, ready for recurring expenses rather than a one-off need.
hmm True. But wouldn't you say that the risk factor is a bit higher with a HELOC due to those variable rates?
Yeah, that's a valid point. I mean, if rates spike, it could get expensive unexpectedly. However, some lenders do offer a fixed rate option for HELOCs for the first few
Right.
years, though it generally shifts back to variable rates later.
So, in a sense, the home equity loan is more stable but less flexible, while the HELOC is flexible but can be a little riskier.
Exactly. And there's also the matter of fees. Home equity loans usually come with closing costs, appraisal fees, origination fees, and sometimes even points, which can really
Yeah,
add up, especially if you're not planning to hold the loan for a long time.
right. And HELOCs generally have lower or even no closing costs, which is a nice perk if you're looking to minimize those upfront expenses.
Definitely. But remember, both options do have that big caveat. Using your home as collateral means if you miss payments, the lender could, come after your
hmm
house. That's a serious risk.
Absolutely. And that's why financial planning is key here.
Exactly.
You need a rock solid repayment plan.
Now, switching gears slightly, there's also the idea of mortgage refinancing, which sometimes can be a better option if you're looking for lower interest rates overall.
Yeah, and mortgage refinancing can replace your current mortgage entirely, though it could also come with its own set of fees and complications.
True. And while refinancing might lower your interest, it could mean extending the term of your loan, which isn't always ideal if you're trying to pay things off quickly.
Right.
It's a trade off.
I have to ask though, don't you think that sometimes lenders might push these products without fully explaining the risks?
That's a fair critique. There's often a tendency to focus on the benefits, like immediate cash access or flexibility, without hammering home the risks of variable rates or the potential for
Yeah.
foreclosure. It definitely highlights the need for thorough research and perhaps speaking with a financial advisor.
So, to wrap it all up, both home equity loans and HELOCs have their merits, but they require careful consideration, especially if you might be stretching your budget.
Yep, you're spot on. It's all about understanding your financial situation, goals, and how much risk you're comfortable managing. And
Exactly.
sometimes looking at alternatives like personal loans or refinancing may be the smarter move.
This has been a really insightful chat. It's given me a better grasp of what each option offers and their pitfalls.
Absolutely, keeping those points in mind can really help homeowners make more informed decisions about tapping into their equity.
Yep. Well, thanks for the deep dive today. I feel way more prepared to navigate these options now.
Anytime. Remember, it's always wise to weigh both the ups and downs before committing.
Mhm.
Catch you next time.